In February 2024, French customs officials made a startling discovery. A shipping container arriving at Le Havre port contained counterfeit luxury goods so sophisticated that even trained authenticators initially struggled to identify them. The haul was valued at over 8 million euros in street value. This wasn't an isolated incident. It was a symptom of a crisis that's been growing for decades. The global counterfeit luxury goods market now exceeds 450 billion euros annually, larger than the GDP of many European nations. And Europe, home to the world's most prestigious luxury brands, sits at the epicenter of this battle. But something remarkable is happening. A convergence of artificial intelligence, blockchain technology, and sophisticated trading platforms is fundamentally transforming how luxury goods are authenticated, bought, sold, and valued. This transformation is reshaping a 400 billion euro industry that has operated largely unchanged for centuries. Welcome to the new frontier of luxury, where algorithms verify authenticity, AI predicts market trends, and digital certificates are becoming as valuable as the physical items they represent. This is the story of how technology is saving and reinventing European luxury.
For over a century, authenticating luxury goods has been an art form, a skill passed down through generations of expert craftsmen who could identify genuine articles by the weight of a clasp, the pattern of stitching, or the specific shade of leather dye. But as counterfeiting technology has advanced, the human eye has reached its limits. Modern counterfeiters use the same factories, materials, and sometimes even the same workers as legitimate manufacturers. They've studied authentic products so meticulously that visual inspection alone can no longer guarantee authenticity. Enter artificial intelligence. Computer vision, seeing what humans cannot. Companies like Entropy, based in New York but operating extensively across Europe, have developed AI-powered authentication devices that can verify luxury handbags with over 99.1% accuracy. Here's how it works. The device uses microscopic camera technology to capture the surface characteristics of materials at a level invisible to the naked eye. Every piece of leather has a unique grain pattern, like a fingerprint. The AI system has been trained on millions of images of authentic luxury goods, learning to recognize not just what genuine products look like, but the subtle manufacturing signatures that counterfeiters cannot replicate. In testing conducted across European authentication centers, these systems identified counterfeits that had fooled experienced authenticators. One case in Milan involved a fake Chanel classic bag so convincing that it had passed through 2 auction houses before AI detection revealed microscopic inconsistencies in the leather compression pattern, a detail that human authenticators, even with magnification, had missed. But the blockchain certificate, creating digital provenance. But AI authentication is only part of the equation. The second revolution is in how authenticity is recorded and transferred. LVMH, the world's largest luxury conglomerate and a quintessentially European company, launched Aura in 2021, a blockchain-based platform for tracking luxury goods from production to resale. Brands including Louis Vuitton, Christian Dior, and Bulgari now issue digital certificates for their products. Think of it as a digital passport for luxury items. When you purchase a Louis Vuitton bag from an authorized retailer, it receives a unique digital certificate stored on the blockchain, an immutable record that cannot be forged or duplicated. This certificate travels with the item through its entire life cycle. If you sell it on the secondary market, the certificate transfers to the new owner, carrying with it the complete provenance history. Richemont, the Swiss luxury group that owns Cartier and Van Cleef & Arpels, has implemented similar technology. For high-value jewelry and watches, each piece now comes with a blockchain certificate that records not just initial authentication, but any subsequent service, repairs, or ownership changes. The implications are profound. In the traditional luxury market, provenance documentation could be lost, forged, or fabricated. With blockchain certification, the ownership history becomes permanent and verifiable. This doesn't just combat counterfeiting, it transforms how luxury goods hold value over time.
Authentication technology has enabled something that would have been impossible a decade ago, a liquid, trustworthy secondary market for luxury goods. The numbers are staggering. The global luxury resale market reached 49 billion euros in 2023 and is projected to hit 89 billion euros by 2028. In Europe alone, this represents a 10 billion euro market, growing at over 12% annually, faster than the primary luxury market. But this isn't just growth, it's a fundamental transformation in how luxury goods function as assets. Vestiaire Collective, the European pioneer. Founded in Paris in 2009, Vestiaire Collective has become Europe's largest luxury resale platform with over 23 million members across 80 countries. But what's remarkable isn't just the scale, it's how they've transformed luxury goods into tradable assets. Every item listed on Vestiaire undergoes authentication at one of their European verification centers in Paris, London, Hong Kong, or New York. Using a combination of AI-powered screening and expert human verification, they've created a trust infrastructure that allows luxury goods to change hands with the same confidence as regulated financial instruments. The platform has processed over 8 million items since inception. The average transaction value in Europe is approximately 400 euros, but individual items regularly trade for 50,000 euros or more. A rare Hermès Birkin in good condition can command prices exceeding 100,000 euros, more than many new cars. Luxury as investment, the financialization of fashion. With reliable authentication and liquid markets, luxury goods are increasingly viewed not just as purchases, but as investments, and the returns can be remarkable. Consider the Rolex Daytona, particularly vintage models. Knight Frank's Luxury Investment Index tracked a 147% price increase for select Rolex models over the past decade. A Rolex Daytona Paul Newman that sold for $200,000 in 2017 sold at auction for $17.8 million just months later. Though this is an extreme example, it illustrates how certain luxury items have transformed into alternative investment vehicles. More typically, limited edition Hermès Birkin bags have shown average annual appreciation of 14% over the past 35 years, outperforming the S&P 500 over the same period. This isn't speculation, it's supported by transparent market data now available through platforms tracking luxury goods prices in real time. European luxury investment funds have begun to emerge. Rally, a platform that allows fractional ownership of collectible assets, has offered shares in a rare Hermès Himalaya Birkin for as little as 50 euros, democratizing access to luxury investments previously available only to the ultra-wealthy. AI-powered price discovery. Platforms like Rebag have developed proprietary AI systems called Claire AI that can estimate the resale value of luxury handbags with remarkable accuracy. Upload a photo of your bag, and within seconds, the system analyzes brand, condition, market demand, and historical pricing data to provide a real-time valuation. This price transparency has fundamentally changed luxury retail. Increasingly, consumers check resale values before making primary market purchases. If a handbag holds 80% of its retail value after 2 years of use, that effectively makes it a 20% rental fee for the time owned. Brands are now being evaluated not just on design and craftsmanship, but on value retention, a metric that can be precisely measured thanks to AI-powered market analysis.
Building the trading infrastructure. Creating a functional luxury trading market requires more than authentication technology. It requires the entire infrastructure of modern financial markets: payment processing, insurance, regulatory compliance, fraud prevention, and cross-border logistics. Payment systems and instant liquidity. Traditional luxury consignment involved lengthy wait times, weeks or months between listing an item and receiving payment. Modern platforms have compressed this to days or even hours. Rebag's instant payment system offers sellers immediate liquidity. Bring a luxury handbag to one of their European locations or send it through their authentication process, and you receive payment instantly, sometimes within 24 hours. The platform takes on the inventory risk, leveraging AI-powered demand forecasting to predict how quickly items will sell and at what price. This instant liquidity transforms the psychology of luxury ownership. Items are no longer sunk costs sitting in closets. They're liquid assets that can be converted to cash on demand. This has profound implications for luxury consumption patterns, particularly among younger European buyers who view luxury goods as rotating portfolios rather than permanent collections. Cross-border trade and regulatory complexity. Europe's luxury market operates across borders in ways that would be impossible without sophisticated technology infrastructure. A vintage Chanel bag might be listed by a seller in Milan, authenticated in Paris, purchased by a buyer in Stockholm, and financed through a German bank, all within 48 hours. Managing this requires navigating a complex web of regulations. VAT rules vary across EU member states, import duties apply to items from outside the EU, consumer protection laws differ by jurisdiction, anti-money laundering regulations require customer verification for high-value transactions. Platforms like Fairfetch, valued at over €1 billion before market challenges, built entire technology stacks dedicated to regulatory compliance. Their systems automatically calculate applicable taxes based on buyer location, seller location, and item origin. They handle customs documentation, verify buyer identity for transactions exceeding regulatory thresholds, and maintain audit trails for tax authorities across multiple jurisdictions. Insurance and risk management. High-value luxury items moving through trading networks represent significant risk. What happens if a €50,000 Patek Philippe watch is damaged in transit? What if authentication later proves incorrect? What if a buyer commits fraud? Specialized insurance products have emerged to address these risks. Companies like Brightco offer instant luxury goods insurance with premiums calculated by AI algorithms analyzing item value, shipping route, and claims history. The policy activates automatically when an item enters the trading network and adjusts dynamically as the item moves through authentication, shipping, and final delivery. Chronext, a leading European luxury watch trading platform based in Zug, Switzerland, provides 5-year warranties on all watches sold through their platform. This warranty travels with the watch to subsequent owners, effectively creating a certified pre-owned market similar to luxury automobiles, but for items worth tens or even hundreds of thousands of euros. Fraud detection and prevention. The luxury trading ecosystem is a target for sophisticated fraud. Criminals attempt to use stolen credit cards to purchase items for resale. Sellers list counterfeit goods with fabricated authentication. Buyers initiate false damage claims. Organized crime groups use luxury goods for money laundering. AI-powered fraud detection systems have become essential. These systems analyze patterns. Is the buyer's shipping address consistent with their payment method location? Has this seller previously had authentication failures? Does the transaction pattern match known money laundering behaviors? Is the buyer's behavior consistent with legitimate luxury consumers or with professional resellers? StockX, an American platform with significant European operations, processes millions of luxury transactions monthly. Their fraud detection systems flag suspicious transactions in real time, requiring additional verification before proceeding. In 2023, they claimed to have prevented over €150 million in fraudulent transactions through these automated systems.
Europe's strategic position. Europe doesn't just participate in the luxury market, it dominates it. And this dominance positions European companies uniquely to capitalize on the technological transformation underway. The heritage advantage. Of the world's top 100 luxury brands, over 60 are European. The big 3 luxury conglomerates, LVMH, Richemont, and Kering, are all European companies controlling portfolios worth hundreds of billions of euros. This isn't just market share, it's centuries of accumulated brand equity, craftsmanship knowledge, and customer relationships.
When LVMH implements blockchain authentication across Louis Vuitton, it's not a startup experimenting with technology. It's a 200-year-old brand leveraging its heritage to enhance trust in digital systems. European luxury brands possess something invaluable in the digital age: provenance data. Archives containing decades or centuries of production records, design specifications, and authentication details. This historical data is precisely what's needed to train AI authentication systems effectively. Hermes, founded in 1837, maintains meticulous records of every Birkin bag ever produced, over 200,000 units across decades. This comprehensive data allows their AI systems to authenticate not just current production, but vintage pieces, creating a complete authentication ecosystem spanning the brand's entire history. Regulatory innovation. The European Union's proposed Digital Product Passport, set for implementation by 2026, will require digital tracking and authentication for various product categories, including luxury goods. This regulation effectively mandates what progressive luxury brands are already doing voluntarily, creating blockchain-based certificates, tracking provenance, and enabling circular economy models through authenticated resale. European brands that have already invested in these systems will have a significant advantage over competitors when regulations take effect. They'll have years of operational experience, refined authentication processes, and established customer trust in digital certification. The sustainability connection. European consumers are driving global demand for luxury sustainability. A 2023 survey found that 73% of European luxury consumers consider sustainability when making purchase decisions, higher than any other region. The authenticated secondary market directly addresses sustainability concerns. Buying a certified pre-owned Gucci handbag instead of a new one reduces environmental impact while maintaining the luxury experience. Platforms marketing this sustainability angle have seen explosive growth in Europe. Vestiaire Collective reports that its platform prevented approximately 90,000 tons of CO2 emissions in 2023 through facilitating secondhand luxury purchases instead of new production. This environmental benefit, now quantifiable through data, transforms luxury resale from mere frugality into conscious consumption, a powerful marketing position in European markets.
Luxury meets private banking. Switzerland has long been synonymous with private banking and wealth management. Now, Swiss financial institutions are beginning to treat luxury goods as a legitimate asset class with profound implications for both industries. Luxury-backed lending. Several European financial institutions now offer loans collateralized by luxury assets. Own a collection of rare watches worth 500,000 euros? You can borrow against them, typically up to 50 to 70% of authenticated market value without selling. Sutton & Associates, a London-based specialty lender, provides loans backed by luxury watches, jewelry, and handbags. Their process is entirely digital. Submit photos and documentation, receive AI-powered preliminary valuation, ship items to authentication facility, and receive funds within 48 hours. Interest rates are comparable to secured personal loans, typically 6 to 12% annually. This creates liquidity without requiring sales, important for collectors who want to maintain their collections while accessing capital. It also represents recognition by traditional finance that luxury goods, properly authenticated and valued, are legitimate collateral comparable to real estate or securities. Portfolio integration and diversification. Progressive wealth managers are beginning to include luxury collectibles in diversified portfolios, not as hobbies or passion purchases, but as calculated allocations within overall wealth strategies. The logic is compelling. Luxury goods have low correlation with traditional financial markets. When stock markets crashed in March 2020 during COVID-19 panic, rare watch prices initially dipped but recovered within months, while equity markets took far longer to recover. During inflationary periods, physical luxury assets often appreciate as investors seek tangible stores of value.
Deloitte's 2023 luxury report noted that 42% of ultra-high net worth individuals now view luxury collectibles as investment vehicles rather than purely consumptive purchases. In Europe, where wealth management has centuries of sophistication, this represents a fundamental shift in how luxury is conceptualized. Tax optimization and estate planning. The tax treatment of luxury goods varies significantly across European jurisdictions, creating opportunities for sophisticated planning. In some countries, collectibles held for investment purposes receive favorable capital gains treatment. In others, luxury goods can be transferred to heirs with minimal estate tax implications. Blockchain certification creates clear ownership records, essential for tax planning and estate transfers. When a rare Patek Philippe with complete blockchain provenance passes to heirs, there's no ambiguity about acquisition cost, ownership history, or valuation basis, information that's often lost or disputed in traditional estate settlements. Several Swiss family offices now employ specialists focused exclusively on luxury asset management, professionals who understand both the financial mechanics and the operational realities of collecting, storing, insuring, and eventually liquidating high-value luxury portfolios.
The challenges ahead. For all its promise, the digital transformation of luxury faces significant challenges and risks that could derail progress or create new problems. The authentication arms race. As authentication technology improves, so does counterfeiting technology. It's an endless arms race. Criminal organizations have already begun studying AI authentication systems to understand their weaknesses. In 2023, Italian authorities uncovered a sophisticated counterfeiting operation that had reverse-engineered authentication algorithms to identify which details AI systems prioritized. They then focused their counterfeiting efforts on perfecting those specific elements while allowing less scrutinized details to remain imperfect, effectively optimizing their fakes for algorithmic detection. This represents a fundamental challenge. As authentication becomes more systematic and algorithmic, it becomes more susceptible to systematic defeat by adversaries who understand the algorithms. Market volatility and speculation. Treating luxury goods as investments creates market dynamics that can hurt consumers. When rare watches become investment vehicles, prices can disconnect from intrinsic value, creating bubbles. The Rolex sports watch market experienced this in 2022. Prices for models like the Submariner and Daytona had appreciated so dramatically that they became speculative assets. Professional flippers bought from authorized dealers and immediately resold for premiums of 50 to 100%. When luxury demand softened in late 2022, prices crashed, some models declining 30 to 40% within months. Thousands of buyers who had purchased watches as investments faced significant losses. Some had borrowed money to buy watches, expecting continued appreciation. The crash demonstrated that luxury goods, despite their tangibility, can be just as volatile as financial assets. Brand control and market tension. Luxury brands have complex relationships with secondary markets. On one hand, strong resale values validate brand strength and justify premium pricing. On the other hand, thriving secondary markets compete directly with primary sales and reduce brand control over customer relationships and brand image. Some brands have attempted to restrict resale through contractual provisions or by refusing warranty service on items purchased secondhand. These efforts face legal challenges under EU competition law and consumer rights regulations. The tension between brand control and open markets remains unresolved. Regulatory uncertainty. How should luxury trading platforms be regulated? Are they e-commerce platforms? Financial marketplaces? Something entirely new? Different EU member states are approaching this question differently, creating regulatory fragmentation. Questions abound. Should platforms offering instant payment be regulated as financial institutions? Should fractional ownership of luxury goods be treated as securities offerings? How should cross-border luxury transactions be taxed when items never physically enter certain jurisdictions but are bought and sold by residents? These questions will be answered through regulation and litigation over the coming years, creating uncertainty that could slow innovation or create compliance burdens that disadvantage smaller platforms. The future of luxury. So, where does this lead? What does the luxury market look like in 5 years, 10 years? The fully integrated luxury ecosystem. Imagine purchasing a Louis Vuitton handbag in 2028. The moment you complete the transaction, the item receives its blockchain certificate. Your digital wallet automatically stores this certificate alongside payment receipt and warranty information. AI-powered apps track the item's current market value in real time, comparing it against similar items trading on secondary markets. If you decide to sell 2 years later, the app suggests optimal timing based on market analysis and connects you directly to qualified buyers. Authentication is automatic. The blockchain certificate proves authenticity instantly. The buyer can choose to finance the purchase through luxury specialized lenders, offering instant approval based on the item's verified value. Insurance activates automatically during transit. When the item arrives, the blockchain certificate transfers seamlessly, carrying the complete ownership history. This isn't speculation. Every component of this system exists today. What's coming is integration and seamlessness. AI personal luxury advisors. Just as AI is transforming financial advice, it will transform luxury acquisition advice. AI systems will analyze your existing collection, understand your aesthetic preferences, track market trends, and proactively suggest additions that align with both your taste and investment objectives. These systems will negotiate on your behalf, monitoring multiple platforms for items matching your criteria and executing purchases when pricing becomes favorable. They'll manage authentication, handle logistics, update your digital inventory, and even suggest when to sell items as market conditions shift. The circular luxury economy. Perhaps most significantly, technology enables a genuinely circular luxury economy where items flow continuously through multiple owners, each time properly authenticated, serviced, and transferred with complete provenance. This model aligns with European sustainability priorities while maintaining luxury's essential value proposition. Items don't lose prestige through ownership transfer, they gain it, accumulating history and provenance that enhances rather than diminishes value. Brands are beginning to recognize this. Gucci's Vault platform blends new and vintage items, presenting pre-owned pieces not as inferior alternatives, but as unique treasures with distinctive histories. This reframes luxury from conspicuous consumption to conscious curation. Conclusion. The transformation of Europe's luxury market represents something rare, an industry managing to embrace technological disruption while preserving the heritage and craftsmanship that defines its value. AI authentication protects brand integrity. Blockchain certification creates permanent provenance. Sophisticated trading platforms provide liquidity and transparency. Financial integration treats luxury as a legitimate asset class, all while European brands maintain the creative excellence and manufacturing quality that made them valuable in the first place. This isn't technology replacing luxury, it's technology amplifying luxury's fundamental promise, items of enduring beauty and value that transcend their functional purposes.
The €10 billion European secondary market is just the beginning. As authentication becomes more reliable, trading becomes more sophisticated, and financial integration deepens, we're witnessing the emergence of an entirely new category of alternative assets. One where Europe's historical advantages in craftsmanship and brand equity positions it to dominate for generations to come. The digital revolution of Europe's luxury has arrived, and it's being written in Europe.